Hello and welcome to the Closing Beat, everybody. Happy Wednesday. How you doing out there? Good. All is good, I hope. Welcome, welcome. We're going to teach you something here today. Spend a little time on some education, short lesson for you if you'd like, and of course go over everything else because it was kind of a light news day. Just really Jerome Powell and the China ban there, which NVIDIA said really won't affect them. How about the other names though? Like NVIDIA was all over, but we didn't talk about all the other names. That was interesting. Jerome Powell's out there talking in Portugal, all places, and he's really trying to get you to slow down. You know what I mean? Slow your spending down. He's telling you rates are going to remain high. We're going to have to be more restrictive, were his key words there. He's telling you, please, for the love of God, stop spending money. That's at least what he's trying to say, but can't actually say it. You got mortgage applications are higher. You got sentiment hitting a new high. I'll talk about that in a second. You got the stock market rallying over here, basically rallying. And so he's like, no, we need you to stop. We need you to slow down, quit going on those expensive cruises and all that great stuff there. And it's not working. I see you guys out there spending your money. The AAII sentiment indicator, market sentiment indicator turned positive yesterday for the first time in 17 months. I know that because 18 months is the record. And so Warren Buffett out there reiterating his comments of, remember, be fearful when others are greedy and greedy when others are fearful. Right now, people are being greedy, and those, presumably, you should be a little fearful is what he's saying. So you got the S&P here. Bank stress tests are probably coming out as we speak, or is that tomorrow? They'll be coming out. So that'll affect the banking sector and usually affects the market after hours. It's not too big of a mover unless there's some wildly crazy thing. Expect them to get a little more attention here thanks to the bank failures since the last time this happened, or the stress tests anyways. Nonetheless, not bad, right? The question is, how much better can it get? Yesterday, on the Closing Beat, we talked about why there would be a cap on the upside of the market. And that's a tough thing to say because I know, you may feel differently, it may look differently, but you've got to be weary of that to the upside. More and more analysts on a daily basis are saying, this is great, but we're not likely to continue. They're calling it flat from here. So chop, essentially. What we saw back in here, they're expecting that to start happening again because there's no good reason for the market to continue higher, even with all the AI hype and excitement. The NASDAQ up 30% here in the first half. There's only a couple days left in the first half of the year. And so that's the third best first half start to the year. In other words, just look at cut the year in halves, right? That's the third best start. The second actually was in, did I write it down? Was in 1983, 39.6. And the best first half start to the year was in 1975, 44.3%. Does anyone want to bet that the 30% gain in the first half will remain that way as third place and will not get any better? You know what I mean? That would be like, what, a 9% gain in, what, two more days, 2 full days there. So not likely to happen. It's likely to go down as the third best first half ever there. Nonetheless, the NASDAQ is extended. Remember, that's sort of normal, frustrating, but sort of normal, that it can remain what is considered overbought on a technical basis there. And that is certainly the case that we actually have right now. So there you go. We'll see what happens there with the NASDAQ. The lesson of the day is on the Russell 2000. The Russell 2000 is currently attractive on a valuation basis, also on a price basis as well, right? Now, to look at this, we don't use PE ratios. Like most people just go, what's the PE of the S&P and what's the forward PE of the S&P, 19 and 22. We don't do that for the Russell because a lot of companies are smaller and they don't have the E in PE, right? They don't have earnings. They're not profitable yet, or they don't have real analysts forecasting forward earnings there if there's going to be any earnings. So what we use is or what everybody uses for this, if you're looking at the Russell 2000 trying to find fair valuation, is the price to book ratio that helps us avoid some of that problem from not having the E in earnings, right? So real easy there. If we go over to a sort of a quick view of that, we're currently trading at 1.9 times trailing price to book earnings, which ranks down here in like the 15th percentile, right? So it is currently undervalued, right? In 2015, which would be right in here, the Russell outpaced the S&P following this valuation dip. It outpaced it by 16%. In 2019, when we did this, we were in the same area there. It started to outpace the S&P, then COVID hit and everything just fell apart there. So, that's part of that one there. Now, does that mean that you go all in on the Russell and you say it's good valuation, that's where I'm going to put my money? Absolutely not. The Russell is considered lower quality, higher risk. There's a chance for a higher return, but it's considered lower quality. And we say that because about a third of the Russell 2000 there is not profitable. They don't make any money. 32% of stocks there will not be profitable over the next 12 months there. So that stems from the Russell 2000 largely being what's 10% of pharma and biotech stocks. And those guys are just trying to build their drug, right? And build it up. They don't make any money during the research phase and during the qualification phase and all of that. And so that is why you don't go all in on the Russell 2000. However, it's a discounted area. And presuming that you assume there's going to be a soft landing, that's good. That could kind of offset the higher interest rate environment and maybe help this stabilize there. So I don't know, something to consider. And I thought that'd be a cool lesson of how to sort of match the price to book earnings, which is also 19 for the S&P versus the Russell, which is 1.9. No? Is that some kind of lesson there? Right? Stuff that we don't normally talk about, that when I think of it, I'm like, do I take that for granted? Do people know that? Should I share that? So that's what you have going on over there. What else can we do here? Everything good? Yeah, everything's good. You remember the yield curve inversion? What happened to that? Like the yield curve inverted. We're going into a recession. The yield curve is still inverted, actually. It's still there. It's the biggest inversion since 1970. Here, I could just show you. Here, this is from the Fed directly here. So anything under zero is considered inverted. You got to go back all the way here to find a bigger inversion. So late 70s right there during that inflation mess that we had there. Now, the Fed looks at the 10-year versus the 3-month. That's how they determine what's inverted. What's our benchmark? What are we using? And so they actually track this. So it's not that we say, oh, there's an inversion, there's going to be a recession. The Fed, this is actually on the Fed's website right here. They track this, and they assign probabilities to a recession. Notice that they currently have let's call it 71% chance of a recession. Does that rank high or low relative to history? Those are extreme readings. You got to go back to the 70s and early 70s to find a higher reading. So they're very confident that they're going to cause a recession here. And again, this is on their site. This is not like, me making stuff up here. This is on their site. Pretty cool, huh? No, I think so. All right, let's go over here. Couple stocks in the news. Not much here today. And we'll talk about something. Let's see. So you can see this guy. Let me get situated here. Alphabet. I believe this was on CNBC, actually. The company's going to be cutting jobs. Again, another tech company cutting jobs. They're also going to merge Waze. Do you guys use Waze, the traffic app there? My friend Joe just swears by it upside down and sideways there. They're working to merge that with Maps, Google Maps, right? So it eventually just go away. Anyways, they're cutting jobs there. That stock's certainly helping today as far as the NASDAQ goes, but a little bit weak there. And can I just stop on this Spirit Aerosystems thing for a second? Was on TikTok, man. I'm getting beaten up in the comments there. People going, who is this clown? What is he doing there? Everything I said is statistically accurate and factual, and we're about to find out that this strike is going to be pretty much a non-event, right? Everything we talked about. Remember, I don't get the data from here. I get the data from the very people that are running the company. So any updates on that, of course, we could do videos and stuff like that, but ooh, I think the people that commented were the employees that are a part of that union. But other than that, you can see it's a non-event here, really at the moment for the stock. The stock would obviously be cratering if there was a real problem, if there was a big deal or anything like that. It was an overreaction on the news, and of course it's right back to where it started because this is going to be behind us here in no time. Got it? Got it, got it. Hey, one other thing. Maybe tomorrow, if not maybe Friday or after the close, the Supreme Court is going to be ruling on the student loan thing. Remember, you can get $10,000 or $20,000 of your student loans forgiven from Mr. Biden there. And, well, one side says, no, that's not legal. Biden says, yes, it's legal. So it goes to the Supreme Court eventually. That's where it lands or is right now. They're going to make the decision on that. So we may know something by the weekend, those of you that have been holding out, which, isn't it interesting timing? You're about to start having to make your student loan payments again, and they're going to make the decision just before you have to do that. So we'll see. I don't know. I have no prediction on the outcome there. I honestly don't know. I don't think anybody really knows. But we will see. So likely be something that we're talking about there, and we'll keep following up with that. Jazz After Dark here tonight. On Jazz After Dark, we're going to talk about 4 really sort of important line item things to do if you're one of those that says 60. I'm retiring at 60. Whatever I got to do to make it happen. Well, going through enough people where this has happened and people that have wanted to shoot for that goal, I'm just going to share with you how I walk through that process. What do we look for? How do we make those decisions, yay or nay? And what should you consider? So hope you'll check that one out. A lot of good Jazz After Darks here lately, if I do say so myself. Hey, we'll be back tomorrow, of course, to do this all over again. And then we got Wine and Wealth, a class for our clients, of course. So we've got a busy day ahead of us. In the meantime, you enjoy the rest of your day. And slow news day, right? I mean, I don't really have much else to say, so I'll wrap it up. Adios. At Jazz Wealth, we treat you like family. That was going to be our slogan, but the employees here took it a little too seriously.
You bought what? That wasn't in the plan that I built for you.
Oh, quit crying.
Don't spend one more dollar.
I'm gonna start calling you Sylvester because you sound like a real...
Tú siempre estás llorando como un bebé, llorancito.
I'm not mad. I'm just disappointed. That's how you get your identity stolen.
We decided to go with let our family be your family's advisor.